Welcome to another episode of Trends and Ideas. I'm your host, Brian Egley. Recent data show big U.S. banks, criticized for their role in the financial crisis and shortage of customer-friendly services, are gaining ground with regard to customer satisfaction. Joining me to discuss this trend and what it might mean for investors is S&P Capital IQ equity analyst Eric Ojia. Thanks for being here.
Thank you, Brian.
Eric, customer satisfaction among banks, including the big ones, appears to be on the rise. Can you tell me what's been some of the challenges that banks have been facing with regard to customers?
Well, first and foremost, we should talk about the setting. And the setting for consumer banking is pretty bad right now, possibly improving. But what's really bad is that the interest rate, the yield curve is still flattish, which really hurts profits for these banks. Customers are still have vivid memories of the financial crisis and the bailouts, and regulation has been increasing. Banks have lost very lucrative overdraft revenues, debit card and credit card revenues. So we're talking about low revenue growth and increasing costs.
What are banks doing to address these challenges?
Well, the first thing that they're doing is an increasing usage of technology. For instance, ATM machines are more user-friendly. They can accept checks without envelopes. And basically, banks are trying to have customers not have to wait in line for the teller. ATMs do a lot more than they did even 5 years ago. And the other thing is to improve the branch experience. I mean, it really helps to have a nice place. Also training the tellers better and trying to get more of the personal contact.
Okay, sounds good. What's your outlook for the U.S. banking industry as we head into 2014?
We have a positive outlook on the U.S. banking industry. We think that many of the trends that went against banks in the last few years, like the flat interest rate yield curve, should start to normalize starting in this year. We think loan growth should improve, and we think that overall the U.S. economy is improving in terms of housing prices and consumer confidence, and we think banks could benefit from this.
Is there a stock recommendation you can share with us today?
Yes, we have a strong buy recommendation on the shares of J.P. Morgan Chase. We think that they are well poised to benefit from many of the trends that I just mentioned, including improving housing prices, more car loans. We also think they're doing an excellent job of improving their consumer banking experience for customers. We think they've done a lot of work in terms of advancing technology, of bringing in customers, of just making it a more positive experience.
Okay, thank you, Eric.
Thank you, Brian.
For more of Eric's stock picks and views on the U.S. banking industry, we encourage our MarketScope.com subscribers to read a related Trends and Ideas story on MarketScope Advisor. It's called Big Banks Are Looking to Win Over Retail Customers. Until next time, thanks for watching or listening. I'm Brian Egley for S&P Capital IQ.